Hello everyone, happy Friday. It's August 18th and welcome to this special all mailbag edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Hope you're having and had a great week. We're here to wrap this week today a little differently. We're focusing on some of the great questions we've gotten recently. We did a YouTube live Q&A this last Wednesday. We're going to be doing that every Wednesday pretty much consistently. So hope you can tune in for those. We had so many great questions this week. We thought it'd be great to spend a little more time digging into the mailbag and going through some of the thoughtful and really interesting questions that we've received here in the last week or so. So we're going to get right to it. Let's open the mailbag and see what kind of questions came across the wire here. Question number 1. Dave, how useful are MACD crosses for market timing? You know, really interesting question, and I guess there's the short answer and the long answer. You know, how useful are they? Pretty useful, I would argue. That's my initial basic assessment of it. But you know, how they are useful, whether they're useful, I think that's clear. How they're useful, I think, is where you need to think about it. What you have to remember, as I'm bringing up the chart here and bringing up the MACD indicator, what you have to remember is, parts of the technical toolkit are more leading indicators, parts are more lagging. And I think you can generally bucket technical analysis tools into one of those. And that's probably oversimplifying, but I like to oversimplify as much as possible. So if you generally bucket things into leading or lagging, right, the certain indicators are designed to tell you, anticipate that something may happen very soon. Others are meant to be more confirmational, lagging indicators that tell you something just happened. And I think both of those have value, and I like to use a little of both. The chart that I'm showing you here now has the S&P 500 with RSI, which I would generally think of as a more leading indicator, with MACD, which I would think of as more of a lagging indicator. Now, what do I mean by that? Well, look at sort of the middle of this chart, which is summer into early fall of 2022. RSI is a leading indicator, meaning it tells you when a market is overbought, which usually happens while an uptrend is still happening, but it's at the later stages of it. You also find things like divergences, like at the end of July, where the market's making a new high on weaker momentum. So again, the price is still going up, but the indicator's telling you we're starting to show conditions similar to previous tops. And the opposite can happen at a bottom too, right? Look in September into October, you have a bullish divergence with lower lows in price, higher lows in momentum, telling you that price is still going down, but the momentum is dissipating, right? There's less downside momentum. So I think of that as sort of a leading indicator telling you that some inflection point may be coming very soon. MACD is more of a confirmational indicator, more of a lagging indicator. So it really doesn't signal until the trend has actually reversed. So if you look, the peak actually came in August. This is when the S&P was testing the 200-day and then it rolled over. And after the top, that's when the MACD indicator actually registers a sell signal. And you can see that with all of these previous tops as well. It doesn't, pick the peak. It happens after the prices actually turn down, because the way it's calculated, it's actually designed to be a lagging indicator, a trend following indicator. It's not meant to, to jump ahead of a turn, generally speaking. It's meant to more confirm that a trend has happened. I would say that is, one of the many things that I think we've seen here recently. But look at the end of July, it's showcasing that relationship between leading indicators and lagging indicators. But a lot of things at the end of July indicating, a weakening of momentum, even though prices were going higher, a lot of divergences around, and then something like MACD and PPO all gave sell signals at the end of the month, sort of suggesting that the top had now been in play. Now they're all sort of going to the downside. So what you're looking for now during a pullback phase, do we become oversold? Do we get any sort of bullish divergence? And then after a bottom maybe happens, that's when you look down to see if the MACD is confirming that. So I would say in terms of market timing, in general, being long when the MACD is bullish and being out or short when the MACD is bearish overall tends to do pretty well. And again, there are little whipsaw sort of things that will happen with any indicator, but certainly in a trending market, it's exceptionally powerful. Next question. Dave, what's your opinion on overweighting small cap stocks? We actually had a number of questions about small caps this week. Another one, what percent should a person have in small cap stocks or ETFs? So that is a tough question to answer in terms of generalizations, because I think that plays a little bit more to what your portfolio goals are, and that this is where I hesitate to make any generalizations about it. But let me explain a little bit about what small caps really represent. And I'm looking at actually a chart. Actually, hold on. I'm actually looking in my Mindful Investor Live chart list. I have a chart that looks at small caps versus large caps. That's a good play. Here we go. So if you, the general sort of, market wisdom or market maxim about small caps is they are, higher beta, higher risk. And what beta means is basically the relative risk or really the relative volatility, right? When the S&P moves 1%, how much does this stock or ETF move? And a beta of 1 means it moves in a similar volatility to the S&P. A beta of 2 would mean it's more volatile. A beta of 0.5 would mean it's less volatile. So a utility stock tends to have a lower beta. A biotech name or a small cap technology name would tend to have a much higher beta. And this is because those types, small cap companies are usually less proven. They're probably earlier in their the cycle of the normal cycle of a company's maturity. They're sort of in the early growth, the explosive growth stage, maybe just before that. Unproven, untested, and in many ways unknown. So the general natural progression of a stock, if all goes well, is they're a small cap stock, and if they do well enough, they graduate into the mid cap index, and then if they do well enough, they graduate into the large cap index, right? And that has happened. That's the story of most equities. I mean, pretty much all equities that we track now started as a small company of some sorts, not all of them, but many of them, and then sort of progressed through that at some different point of time. So, in general, when the market is more risk on, small caps tend to do better, generally speaking. When the market is risk off, more defensive, small caps tend to do less well. And so the challenge right now, I would say, is do you want to own small caps when we're getting all these signs of a corrective period? I'm not sure that would be the general way to think about it. Here's the thing that makes it a little different here, right? If you look at the chart of relative performance of small caps versus large, so I'm using the IWM versus the SPY here. This line is going down. Small caps are underperforming. This line is going up. Small caps are outperforming. Small caps actually outperformed for much of 2022, really from May on, and really into the first quarter of this year. They performed quite well on a relative basis. Then in the middle of 2023, this is when the FANG stocks, what we're now calling the Magnificent Seven, really accelerated. And it felt like Microsoft and Apple and Alphabet and Meta are doing well and everything else is kind of languishing. This is where the small cap index really started to underperform. Now things are sort of, rebalancing a little bit. You're seeing the outperforming growth stocks starting to come back down to earth. You're seeing underperforming groups like energy, materials starting to improve a little bit. Even underappreciated sectors like utilities, defensive sectors like real estate. So those types of sectors, particularly like financials, are much better represented in mid caps and small caps, and they have much less of a weight in technology. So if technology and communication services are going to struggle, that probably bodes well for the small cap index because they have a less overweight in those sectors. So, so if you're thinking that sort of rotation is in play, small caps may be an interesting place to do that. Generally speaking, I think in terms of overall diversification, having some exposure to small cap stocks is usually a good idea for many investors because when the market is working over time, right, for longer term periods of time, makes a ton of sense. So in retirement accounts, a lot of people would have small caps, and I think that makes a good amount of sense. Again, if your runway is long enough and you can benefit from, you can weather the uncertainties of the short term and benefit from the long term story of small caps, I think that can be pretty helpful. But summary point on this one is it a good time to own it right now? I'm not so sure because as the market is in sort of a risk-off posturing, I would say probably small caps aren't going to do particularly well. If and when we get that rotation higher in the fourth quarter, that's when I think small caps probably deserve some good attention. Next question. How would you define the proper trailing stop loss percentage for a stop? Really good. Some of the questions this week just really interesting. It's sort of general, more money management questions as opposed to particular technical analysis. But we got a mix of everything, so I'll take it. What's the proper amount? It's hard to generalize, but I would say my first answer to that question is having a trailing stop is better than having none. So I think too often in the investing world, we tend to try to optimize, right? We spend so much of our time and attention reading books, reading articles, attending events, trying, following on social media, trying to find that one thing. And we just have this feeling that if we just find that one thing, that holy grail, this is all going to get really easy very quickly, and we just need to follow those signals. As many times as you will see marketing pitches with that sort of implication, that is, I think, a mirage for most investors. I know very few that have found that thing. I don't think that thing really exists, to be honest with you. And if it does, it works for a specific set of circumstances, and then it magically doesn't work. It works really well until it doesn't. So to be honest with you, I would say having a trailing stop of some sort is really good and much supremely better than having no stop. And that's what concerns me. A lot of people just don't have a good exit strategy at all. So assuming you have one, which is a great first step to take, what is it? And I would say it can go from the very simple to the more complicated. And I'll give you just a couple ideas, the three that come to mind. The number one would be a simple percent stop. What's good about that is, you buy Home Depot for whatever reason, not a recommendation. Let's assume you bought Home Depot this week, and you're betting it's going to break out above 340, but you just want to lock in those gains. So maybe you want to think about, okay, let's say I bought, and I want to make sure we remain, at least 8% above those highs right there. Okay. And, 8 to 10%, if I would pick sort of the, what's a good percent to use, if I just want to say, just back of the envelope, make sure I lock in and minimize my losses. 8 to 10% is probably what I would suggest. So 8% is what I've used for years and years, which means as long as we remain at least, the 8%, we don't get below 8% off of the previous high, it's still a pretty good chart. We break that, I would be concerned. Now, I use the percent change tool to just say off of the highs, go down 8%. That gives me a level of around 310. Then the next thing I would do, we have this tool on StockCharts called Auto Support and Resistance. It's a really cool thing. You basically draw a horizontal line, and then it automatically just shows if the price is above that line, it's green. If it's below that line, it's red. And if you're using the StockCharts platform to track your positions, track your portfolio, which I think is a really good idea. I have chart lists with different portfolios that I'm running, different accounts. And for many of them, I will put these lines on with entry points, right? So here's my point, and not just entry points, but put them on stop levels, right? And use comments to sort of differentiate what's what. And what this means is if you have a list of charts, you can go through those charts very quickly. And as long as the lines are all green, you're holding above your stops. And as the price goes higher, you could certainly bump your stops up and keep moving them higher. And again, just stay on those as long as the line remains green. If you start to see a red, then you revisit that because that means you've gone below that level. So that would be an easy percent stop, and that's how I would use the StockCharts platform to do so. There are other ways that get more complicated. I would say the other two to remember down here under overlays, parabolic systems, which is a technique that Wells Wilder created. He created RSI and DMI, the ADX, other indicators you may know. Also the parabolic systems, the SAR points, stop and reverse points. It's a simple trend following system that simple is good, I think, a lot of times. Then I guess the next level beyond that would be the chandelier exit. Read Alexander Elder's books where he talks about the chandelier exits. Uses average true range, which is a little more dynamic way of doing that percent stop that we mentioned. I would hope you can get there at some point in your investment journey. Get down to something like chandelier exits. That's a really good way of using average true range, the volatility of the stock, to determine your stop points. Great question there. Next one, what are your thoughts about the China Internet ETF, KWEB? So what's interesting about China is one of my guests this last week, Ms. Schneider, was giving a bullish take on China, which is interesting. We really haven't looked at China a whole lot. I haven't looked at it on the show very often. I think we looked at the FXI actually on the show, which is interesting. It just started to rotate higher. I think the issue with all of these charts in this particular type of environment is you have to make sure that you have a good stop loss strategy for any of these. And I would say that is the way that I think of investing in a corrective phase. It's a real focus on stops. And that's why I loved your question about proper trailing stop, right? Any of these trends, if the broader macro environment just gets really negative and people just start taking risk off, they will do it with wild abandon. They won't be very picky and choosy about where they're taking positions off. They'll just unwind to preserve capital. That all of a sudden rotate. Even things that should work start to not work. So with FXI, we'll get to KWEB in a second. FXI, nice breakout above 30, but it fizzled very quickly. Now we're below trendline moving average support. Now we're testing the lows. I'd be interested to see if the May low holds on the FXI, but I'm skeptical given the rollover that we've seen. With KWEB, it's still, again, in a similar position, which was really trying to break out. Getting above 30 seemed like a really good start. It failed at previous resistance here, the March and April highs at 32, and now we're back testing the lower end of this. So if you're buying KWEB here, you're betting on a bit of a mean reversion from this level. For me, given the correction sort of feel that I'm seeing, or certainly the pullback phase that we're seeing in the US, and I think in global equities as well, the weakening that I'm seeing in risk assets, I'm not inclined to take a shot at something like this until that sort of works out. So I would probably be waiting on something like this. But having said that, if you are taking a position in something like this, stops are critical. This is a time for tight stops because there is a very real chance that this gets really ugly, much uglier than it has been so far. So that's my quick take on KWEB. And again, I think the story here is that fail to break above resistance. That's what happened in the last couple weeks. Next question. Dave, when the RSI trend line is broken to the upside, does that negate a bearish divergence? Really good question. Actually, you had a chart of Amazon. Let me see where I saved that. I think I put it in here somewhere. Hold on. Maybe in here. You were looking at Amazon. Oh, no. I think you were just looking at Amazon with RSI. That's what it was. Yeah, and I remember you sent an image of your chart, which I appreciate. And I kind of could recreate it pretty quickly with my sort of normal chart, so I'll do that. You were kind of highlighting this point here. This is the chart of Amazon. Pretty impressive run, obviously, in 2023 after bottoming out in December. Amazon, one of the two FANG stocks, still narrowly holding the 50-day moving average. Alphabet's the other one. The other sort of magnificent seven have all broken their 50-day at this point. But Amazon testing the 50-day here at the in mid-August. So for now, still holding up okay. You were asking about this point right here, though, which is we had a clear bearish divergence. And we talked about that a lot on the show, right? And, Microsoft, Apple type of names had those divergences rolled over. You saw divergences on charts like Amazon and so many others, right? In June, July, higher prices, but weaker momentum. You're asking about this point here. Does that break there negate that bearish divergence? Interesting question. In my opinion, no. I don't think that's the story. I guess the way that I think about it is the bearish divergence for me puts this sort of chart on a watch list of potential breakdowns, sort of like a red flag list. Like this thing has had its run. And now you're looking for signs of a breakdown. At that point, I'm no longer probably looking for the RSI for the big confirmation that, as like a stop for that. I'm looking more for price. So for me, the early warning signs are a divergent. Now I would switch to more lagging indicators, using indicators like MACD, PPO, referring to the question earlier about leading indicators versus lagging indicators. I would switch to more of the lagging indicators to see when you actually get the breakdown, but nothing better than price, right? So if you look at what happened after the divergence, we never really broke down, right? We didn't make a lower low at all. We held the swing low around 125. So after this divergence, this is where you'd probably see a break, right? A break of the 50-day, a break of support. That would be the trigger, the sell signal in my mind. It never came. We actually found support at the 50-day. We didn't make a new swing low, and then we gapped higher. So in my opinion, Amazon is one of those few charts that actually still looks pretty constructive here because it keeps making higher highs and higher lows. So I think it's less the fact that the divergence got, broken this way. I think it's more the fact that the follow through you would look for never really occurred. And that's the trigger that I think we're still waiting for on a chart like Amazon. So I'd encourage you to link the divergences, how you're using RSI, to other indicators that are more confirmational. I think that would help you play a chart like Amazon and avoid, kind of going short prematurely or selling too early if the uptrend is still in place. Great question, by the way. Next one, would like StockCharts to host a scanning boot camp. Is this a consideration? Man, we're open to anything. having a scanning boot camp is not something that I've certainly been talking about. And I'll tell you why. Our scanning engine is incredibly powerful, but boy, it needs a refresh. And that's actually in the works. So our development team is sort of sketching out the new plans for the scanning engine. If you've been following StockCharts, and I hope you have, there's been so many great additions and features that have come out on our platform. If you go to stockcharts.com/new, you can see our latest release, which was called Deception Pass, came out in June. Some really great additions. One of my favorite was the fact that on price alerts you can actually add a little note in there, which is really cool. We have earnings and revenue data on our platform, historical data, so you can actually look at changes, historical earnings surprises. And I mean, again, we're just scratching the surface on all the things that we want to do with our platform. The things that we're working on currently, just so you know. If you go to your dashboard in the upper left, we have a couple things in green called technology previews. The three big ones you're going to see are the new Sharp Charts workbench. So the traditional kind of Sharp Charts, that's what StockCharts has looked like this for a while now. All of the stuff around this chart is getting an upgrade, and a really powerful one. And I will tell you, we're not losing any functionality. We're just making it better. And people like me and Grayson Rose and other power users of the StockCharts platform have been working with our development team to really focus on what we could do to elevate the experience of using our charts. And I'm really proud of the team of what they're working on. So you can see a preview of what it's kind of going to look like, and that'll be released here very soon before the end of the year. Sharp Charts 3.0 is a complete redesign of our charting platform. So one of our head developers has literally started over from scratch, built it on an entirely new charting engine. We're going to have so many cool capabilities once that is ready, and you'll see a preview there of what kind of cool user experience you can have when that is released. That'll be a good tool as well. And then the market carpets, the new version of this, I think blows any other heat map out of the water. It's going to be really, really cool. So those are some pretty big efforts that we have our development teams focused on for now. After that, we're going to get into other things, and the scanning engine is one of those. Again, the underlying engine is actually incredibly powerful. We can just do a lot more to allow you to screen for ideas. So that was a long-winded way of saying, once we have the new scanning engine ready, I have that on my list. I would love to think about doing a boot camp of sorts, but I'd much rather wait until we have this new powerful tool, because then we're going to want to make sure that everyone has those capabilities. Maybe we'll do a virtual one for people all around the world. Maybe we do one as part of ChartCon next year. I don't know. But thanks for that suggestion. I appreciate it. Next one. What process do you use to allocate the securities in an account? And I really appreciate it. And you ask a number of questions, like, is it more subjective? Is it equal weighted or dollar weighted? Is it based on some technical methodology? So again, I full disclosure, with my own investing, as someone who is a strategist, and much of my career has been, advising others on what stocks to buy or sell, I've always been very limited in terms of what my own trading can look like. So I've never really had an active trading mentality, because I've never been able to. I actually technically could now. With my work at StockCharts, the compliance is not super rigorous as much as if you worked at a money management firm or managing client assets. But it's just not a part of my process. So so with my own personal account, I actually do very little with individual. Much of it is done more systematically and done to try to equalize risk. So I go for a pretty balanced approach, and a momentum-based approach. And about once a month, I do a big rebalance if needed to shuffle things around. Maybe a rebalance coming up here at the end of August, depending on how crazy things get. But I remember being tilted into large cap growth here on the last rebalance. So see if that's still relevant here at the end of the month. A lot of game left, as they would say. But what are the best practices in terms of allocating securities in an account? So I would say the subjective, or what I would call conviction weighting, feels like a good idea to people, because they say, if it's a really good idea, I'm going to allocate a greater percentage. If it's a less good idea, I would allocate less. Not a great system, though, to be honest with you, because what I would say is, anytime you do something and the word subjective comes into it, you are literally opening yourself up to behavioral biases, I have found, right? So when you're conviction weighting, you are much more likely to be subject and to be vulnerable to things like confirmation bias, which is, making the decision first, then gathering the evidence. what else would be in there? Like a narrative bias. You get tied into a particular narrative and then you go all in on this particular thing. I think rates are going up. I think banks are going to work. And all of a sudden, all your positions are based on this one thing happening. And then when it stops playing out that way, you fall victim to other things like endowment bias, where you don't want to trade because of your emotional attachment to what you've already done. So long story short, that is not a great a general thing. Equal weighting or dollar weighting is better than subjective, but it's also not great. And the problem I would have with that is that you are, you're basically saying that any two positions have the same potential. And what's good about conviction weighting or subjective weighting is you are weighting more to better ideas, perceived better ideas. But equal weighting kind of kind of eliminates that. But it's all of a sudden not really taking advantage of the fact that some things are better opportunities than others, or have different volatility characteristics. That gets us to, a systematic technical methodology. I would encourage you to explore ways of taking positions weighted on volatility, a volatility weighting. Tools like average true range, standard deviation, those sorts of things can help you understand that. But basically what you have to remember, it's a bit more of an equal risk weighting as opposed to an equal dollar weighting. Equal dollar weighting says I have $1,000 and I have 10 positions, so I put $100 in each stock. A volatility weighting, or a risk equal risk weighting, basically says if something's more volatile, I want to put less assets at risk because the potential is more magnified, right? So my dollar actually is going to be magnified. So you put less so that the overall, risk weighting of each position is more consistent. That is something I would look into. It's sort of outside the scope of the show to go any deeper into that, but I would encourage you to look at volatility weighting, what I call a risk-weighted positioning. And then the last comment is to just keep your positions small, right? You want to minimize your exposure to any one particular idea. That's where investors at times have done incredibly well, is you go all in on Bitcoin or on Crocs or Starbucks or Alphabet or whatever the name is, and you have stellar gains. You go all in on GameStop, and how many people do you know, and if not, they're out there, who just made a killing and then had all these paper profits and then wrote it all the way back down, and all of a sudden because they had way too much exposure to that one thing. And when it was working, it was great. When it was not working, it was absolutely a nightmare scenario, a nuclear effect on their portfolio. So keep your positions small and thoughtfully allocated. That was my 5 minutes on allocation. I hope that's helpful. Next question, Dave, are there sector comparisons that are noteworthy, like XLY to XLP or XLE to XLK? I really love that question, thinking about ratios. I have a whole chart list called ratios. And I actually include some of these that you asked about, XLY to XLP. That's the first one. I don't have energy versus technology, but I do financials versus technology. You can look at a lot of different ratios. These are just some of the ones that I found most helpful. And the reason why I look at these ratios is because, it really comes from my time spent working with institutional investors or money managers, right? When you're running an institutional level portfolio, billions of dollars, and you have a lot of shareholders that are benefiting or struggling along with your returns. You really and you have to be fully invested, which is what a lot of funds like that are have that specific requirement. What happens is it's not as much, do I want to own stocks or not? It's not an allocation decision. It's more of I know I need X percent equity, so where am I going to go? So it's a lot on relative performance. It's a lot on relative movement of different sectors and different groups, right? Because you're always asking, do I want to own this or this? It's not, do I want to own this or not? It's which of these two? I have to own one of them. Which do I want to do? So ratios became a really important part of my process very early. And I still pay attention to quite a few of them. The most common one that I look at is this one, which is looking at offense versus defense. You asked about the cap-weighted versions of those ETFs, which is fine. If you're going to look at nothing else, I think that's great. I would encourage you to think more about the equal-weighted versions of those ratios, because I think that can tell you a little bit more. It gets away from the mega cap impact of Microsoft, Tesla type of names, and really looks more at the performance of the sectors of the stocks that make up those ETFs. But I would say that this ratio is really helpful. It's rotated lower, both versions, and I think that of anything you're going to look at, breadth conditions, price breakdowns, The fact that defensive sectors are actually starting to outperform offensive sectors is a bit of a concern if you're bullish here. Financials versus technology is another one. Just looking at the relative performance of two sectors and again, the reason why I have this chart is because we are so unprepared for financials to do better than technology. That is just not something we think of as a scenario to even consider. And that's why I think this ratio is so important, because the times when this ratio goes up, investors are just completely unprepared for banks being good bets. They just haven't been for so long. But I think this ratio, if you look, certainly since June into July and August, has done quite well. I wouldn't be surprised if that continues to go higher, given the rate environment, given the steepening of the yield curve, given the fact that technology has been so overextended. I think that ratio goes higher. Energy over technology, similar kind of field. So I would say those comparisons are very valid. I think you've hit on some key ones. Cyclicals versus growth, like energy versus technology, really good. Offense versus defense, XLY versus XLP, XLK versus XLU, I think would all get you to that point. Great question. Next one, Dave, when is the best time to sell a position? I will answer this very simply. The time to sell a position is when the chart no longer tells you that the position is worth owning, right? Let the chart tell you when is the case. On a stock like Alphabet, I think the chart is still going higher, right? I think the trend is still up. And I think we can get into trouble when the chart is going up, but you start coming up with reasons why the chart should not go up anymore, right? If the word should is part of your investment thesis, I'm not a fan of that. I think you want to think more about what the price is actually doing. I'm a fan of following trends as they go up and then selling things when they're no longer going up and waiting for some confirmation that that breakdown is happening. Because I tell you, if you want to be really sad as an investor, sell early. There is nothing worse than selling something when it's gone up 20% and then leaving the next 200% on the table and just watching that go higher when you're no longer invested. Peter Lynch famously said about always being invested, he said, it's awesome to always be caught with your pants up. And his point was, you always are invested. There's no question as to whether or not you're in the market. You're invested, and so you're in there. And so I would argue that you want to continue to let your winners run. And one of the ways you can do that is use a good trend following mechanism to track things that are going up. That's why these stocks breaking the 50-day, I've hit home on that regularly here recently, because I think that is one of the signs you can look for that an uptrend is no longer in play. So I would argue the best time is to sell is when you see clear signs that that trend is no longer in place. The other thing is, go back to my earlier question on trailing stops, and I think some of those methods are also can be good reasons to sell as well. Finally, is it possible to get a copy of your market breadth indicator charts? Yeah, two ways that you can do that. So if you look on, when we go through the show, I have a series of chart lists that I use often. I have a Market Mindful Investor live chart list. I have breadth, sentiment, ratios. These are lists that I've curated that I tweak over time, but overall are sort of the way that I have my StockCharts login set up so that I can follow all of these things that are most important to me. You are easy, I think, able to replicate a lot of what I've done. There are two ways you can do it. To get these actual chart lists as a whole, you want to install the chart pack. And if you're a StockCharts user, this is what I would recommend. Go to where it says chart lists on your dashboard. Go to the bottom of your chart list, and you will find, I have a bunch of these, but if you go to the bottom, you'll see this little button that says Manage Chart Packs. And you want to go to this one called David Keller's Morning Coffee Routine Chart Pack. You'll see a green button that says Install. And what that will do is basically install a group. I think it's about 12 chart lists that I've created that I keep updated. They will basically copy those into your login, and you can go from there. The other thing you can do is if you go to market misbehavior /breadth or market misbehavior /sentiment, you can go right to these chart lists directly. These will be the updated versions that I have updated on my login. And again, if you're a member, you can click on Save to Chart List, save a copy of these right to your own login, and then save them, distribute them, share them, whatever you like. They're yours to enjoy. That is it, folks. Thank you so much for joining us every weekday after the close, and thanks for joining me for this special all mailbag version of the Final Bar. We will be going live this coming Monday August 21st. Super excited to be going live right after the bell at 4 p.m. Eastern, 1 o'clock Pacific. So you can tune in live on our YouTube channel. And as always, we'll have the video posted soon after. So if you've been watching it whenever, in the evening, in the morning, wherever you're at, you can continue to do so. But for those wanting to watch it live, make sure you do that. We're excited to start to incorporate some more interactive elements to the show over time. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good weekend.